Right, well, this is George. I'm now with you. If you can just indicate again that the microphone is working correctly and that you can see everything. Interesting comment there, Philip. I was with somebody some years ago, and we were talking about all sorts of trading-related matters. And the guy was quite a high roller at the time, and he was a builder himself, or had been a builder, before he turned to the world of trading and found it was an awful lot more lucrative than putting up houses and so on. And that's exactly what he did, or at least that's what he told me that he had done, that he'd strategically placed one or two gold bricks in his house, so that if ever there was financial Armageddon, then at least he could pull down half the house and still be pretty well off. Anyway, guys, what we're looking at this morning are various things. We're going to look at trading longer term rather than just coming down to what I tend to specialize in, which is morning breakfast trading. But quite a number of those trades that I put on will very often just run on, and they will run and run and run, but only a piece of the action is what I tend to keep on. So what I'm going to look at is one or two little strategies that can be used, and can be used purely for longer term trading. So these are not necessarily trades that are going to come out of intraday trades, but they will be trades that can be put on without needing to look at the screens during the day. If you can look at the screens during the day, yep, you can put some enhancements on. But let's just look at one or two influences first of all, and that's where I'm coming in here with correlations. Now, all markets are interlinked, okay? All markets are interlinked in some way. Now, some have a very direct linkage, others are pretty tenuous, but the markets that we're interested in, currencies, are influenced by all sorts of things. They're influenced by interest rates, which is one of the main ones, and consequently bond prices. So you can look at bond prices in relation to currencies. And a good many countries are commodity producers or indeed commodity consumers. Some of them do a little bit of both, but again, there are some of them who can only do one or the other. And this particular one is a case in point. Now, at the top here, we've got oil, it's got crude oil. And down below here, we've got a chart of the Canadian dollar against Japanese yen. Now, the Canadians have got reserves of oil. They produce an awful lot right now, and as the price sort of has gone up over the years, they found all sorts of different ways now of pulling out not only oil but also natural gas out of shale, and they have huge deposits. Japan, on the other hand, have to import every single barrel of oil because they've got no oil of their own, and it's no surprise that they shouldn't be one of the biggest investors in Canadian oil shale deposits. So, just look at this correlation. What do we got? Over here on the left, we've got the crude oil price in October 09, moving on up, and it moves up strongly, and it does so for a number of weeks. What is the correlation doing to the CAD-JAPY exchange rate? Well, it's moving it up. So there we are. That's a case in point. Strong oil price is good for the Canadian dollar and very bad for the Japanese. Now, just look at exactly the opposite happens. We then get the oil price coming on down, and lo and behold, what do we got? We got the currency coming down. Now, there always tends to be a bit of an overshoot and undershoot on some of these, and as you can see, what actually led the way here was this hammer, and this can really give you the heads up on what's going on in another market. So we get the heads up now that we've got the CAD-JAPY goes to a new low, but then it puts in this hammer, long tail, small body, and that correlates to that long tail spike down there on crude oil. But of course, what then happened was that we found that crude oil did go on somewhat lower. It went lower, and that low was at just about the right time to get stuck into the CAD-JAPY cross. So look at that. The CAD-JAPY then went on up until January 10, January this year, all the time that crude oil was moving on up as well. And eventually, of course, that trend came to an end. Now, as you can see, I've got these nifty colored charts on here, which actually picks out the change in trend rather neatly. And if one were only trading with these, then that particular trend would have been caught very, very nicely. So there we are. That's the first one that I just wanted to present to you. We've got a correlation that can be used. So where we're getting something that goes out of kilter, and that was a real case in point there, where we had the CAD-JAPY bottoming and moving on up, but crude oil was coming down. They were getting out of kilter, and something had to give. Either the oil price was going to blow, or indeed the CAD-JAPY was going to blow. And what we saw was that eventually the correlation came together and they moved on up. So while they're moving up together, then we stay with a currency trade. Now you can trade either one of these or indeed both. But what I tend to do is to trade one or the other based on some form of divergence away from the norm, and that's exactly what we have there. Right, let's go look at something else. Now, we're looking at the S&P and the dollar index. Now, usually there should be an inverse correlation here. Now, this is the weekly chart, so you don't get much longer term than this. Going way back there to 2006, what do we got? We've got the S&P moving on up as the dollar index is moving down. Now, real interesting case in point, because what we're actually seeing right now is that the S&P is very uncertain, can't quite make its mind up whether it's going to go up or down, and that's exactly what is happening with the dollar index right now. So, let's just have a little look at this. We've got the dollar index here towards the end of 06, and the dollar index starts to decline, starts to move on down, but whilst the S&P has already started, okay, this is already moving on up. There was a divergence here. Can you see that? Where you've got the S&P going up and the dollar index didn't start its decline until later. So the S&P is actually leading this one. And then what do we get? We get a move on down, and then at this point, we can see that the S&P has decided that it's not actually going to go any further. Now the correlation started to break down, and it broke down for a number of months, but then it really did thump in again. And it thumped in again. As you can see, there's other little dotted line that you can pick out where the dollar index reached a low there. Okay, so it reached a low in the first quarter of 08. It then put up a beautiful little multi-point reversal where we get a higher low, and then it changed. But of course, the S&P was already moving down strongly. So there we are. That's another case in point. Looking longer term, you can trade one against the other. Get a slight divergence when things are going out of kilter, and sooner or later, they're all going to come back, and they're going to come back to the usual inverse correlation. And you can just follow this chart through, and you can see it again happening just there. Right, okay, so that's taken a little glance then at a couple of correlations that can be really useful for longer term traders. And, okay, it works in the short term as well. This one is a 5-minute chart. So I encourage you to, do have a good look at these, and you'll see this happening on most of the time frames. Right, okay. Now let's move over to a specific strategy that can be used. Now, I presented this at a coaching session that we did last week, and in fact, actually, one of the guys in the room from there, hi Pat, Now, I've combined a couple of things. I'm a dyed-in-the-wool Fibonacci trader. Now, that's not to say that Fibonacci is the only thing I use, and I use a good many things in my sort of toolkit that I want to use to trade. But Fibonacci has got a special place because so often we find that Fibonacci is recognized in trading movements. And I wanted to come up with a strategy that was quite useful, and it was dead simple. It had to be really, 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 really simple. So using a combination of fib and also using moving averages. And I'm going to present a strategy to you which makes full use of the 8 and the 21 exponential moving averages. Now you can use it with simple moving averages and so on. I just prefer exponential because they have a habit of following price action so much more clearly. And then I've got a longer term one, which is a 55. So what we're going to look at now are some low risk entries, relatively low risk entries, which are going to give some really, really good profits. Right, now this is the euro. This is the euro. Particularly good pair for this type of trading. Certainly has been. Of course, things could change. We could find that the dynamics of the euro over a period of time will change completely. And that's true of markets in general. One of the dilemmas, of course, for traders is that one can work out a beautiful system which, with back testing, works absolutely marvelously. And then what happens when people actually put money on the line and trade it for real is that it can change. And that's really only just part and parcel of what does happen with markets. Because if things get too easy, if it gets too predictable, too many people start to profit from it, and that becomes an impossibility. Then other traders start to see what's going on, and they will arbitrage against those systems which are actually working. So, dynamics are always changing in the markets, always changing. Anyway, let's just get down to the detail here and just follow this one through. Down here at the bottom left, preceding this area, price was coming down, okay? It came on down, and it broke a downtrend line. And those of you who've seen my earlier presentations just on trading trends will know that just breaking a downtrend line is not a change in trend, but it can give you the heads up that maybe the momentum part of a trend has actually come to an end, and price is likely then to move sideways. But what actually happened here, as you can see where this little very, very first horizontal blue line is, that price went down to the old low, or at least it attempted to go lower, did not manage it, and it moved back up. It's a higher low. Now, those higher lows can lead to some exceptionally good areas where one really ought to be trading. And what we're looking for is moving average crossover. This is so simple. This is so simple. Anyone, absolutely anyone, can see this and can trade on it. So we've got the shorter term, the 8 moving average, goes up through the 55, goes through the 21, which is the red one, the slightly thicker red one, and it moves on up. Add into this a nice little bit of candle evidence. And you just see there, right on the change in the month, the May, that little green candle? That green candle is an Hallmey. And price of the next candle breaks the Hallmey, all right? It breaks above. And that is the cue to go long. So we've got the moving average crossover, and that's the cue to go long. There's another opportunity here as price comes down with a tail to touch the 21 line, doesn't quite touch it, but then it moves up, more or less completely engulfs the preceding candles. There's another entry. There's another entry just there at 133.97. Yeah, absolutely right, Philip. Yeah. I mean, you can sort of fine tune these, you can back test them, you can sort of play around with putting it on the sort of the mid price. Most charting packages allow you to put it either on the open, the close, or indeed the mid. I just leave it on the close. I've fiddled around with all sorts of different things, And you get a bit of an improvement here, or another one doesn't really quite improve. So I've not really gone beyond wanting to put it just on the closing. It just keeps life simple. Now then, this is how the strategy works. We're long. We're now long. Price moves up, okay, and then it comes back for another correction. And this is just all part and parcel of the backing and filling process that takes place with markets all the time. And this is the strategy. When price comes down, after it has established itself in an uptrend, and the uptrend established is when all three moving averages are crossed over, okay? But then price decides to pop down to between the 18 and the 21, and as it moves back up through the 8, it becomes a buy again. So we get a second buy signal. Okay, we get a second buy signal there that would put us long at 136 or slightly better. Okay, what does price do? It moves on up, moves through a couple of hundred pips, moves up through another 100 pips. So we're up now a good many hundred pips. What does price do? It comes back to correct yet again to between the two moving averages, and then it moves on, and it signals yet another buy there at 140. So where do you put the stops? Well, the stops go in where these little horizontal blue lines are. Okay? So your initial purchase is going to be in the region here of 133. Where's the stop going to go? It's going to go down here below 130. So we're going to have a roundabout, on that initial trade, around about a 400 pip stop loss. Yeah, and there's all sorts of things that actually use that 55 fillet. And it's a very useful one. It's a very, very useful one, as you can see as this chart progresses. So the initial stop then is then going to be moved up as price goes higher. So as price moves up towards the 138 mark, then what are we going to do? We're going to bring the stop up to what will be just slightly better than break even, and it'll go just under that previous low. And then that's all we do. We just keep moving that stop up until such time as the stop is taken out. Now, what I'm going to suggest that you do with all your trades, and this is something that I do and have done for a period of time, is to always split the trade up. So that if I'm trading, let's say we're just going to trade this with conventional contracts, I always trade with 3 conventional contracts. Okay, I'm going to trade with 3 lots, $300,000 of currency. Okay, what that enables me to do, it enables me to leave the original stop where it was, and then I can take profits along the way. So as price gets really extended, I can peel off 100. As it gets really extended and looks as if it might now, I'd be sitting on a whacking profit up here, looking as if it's going to come back down, and there's a key candle here. Now, that key candle is an engulfing candle. So as price comes back down through 42, okay, and breaks down here to just about 140.40, it engulfs. So what do? I peel off another 100,000, taking profit along the way. I'll then, my original 100,000, that stop is going to come up to break even and at a technical level, and it's going to stay there. And it's going to stay there until I get some really good higher low areas that I can put the price in. And what I'm looking for is this 55 to stay intact. And every now and again, price is actually going to pop down to the 55, and it's going to pop up. And then, provided that the shorter term moving averages do not do a decisive crossover, meaning that they don't want to cross over with a close, I stay with the trade. So I've taken profit, I've got money in the bank, I've still got a good part of the position on, and I'm just going to stay with it until such time as eventually we get crossover. Now we get the crossover up here on the far right, and the short-term moving averages cross over, and then eventually the longer-term moving average crosses over, and it looks very much then. So we're looking as if it's just going to cave in to a new trend. So there we go. That's just a very, very, very simple trend following method. And of course, this particular trend worked a real charm. Not all of them do. Many of them will drop into sideways mode. So when that happens, then we've got to be just a little bit careful and a little bit cautious. So there we go. Now, yeah, you never know. You're absolutely right, Manos. You just never, ever know where price is going to go. You never know if a trend's going to continue or reverse, or it's just going to drop into sideways range-bound activity. So, you know, you can certainly use Fibonacci retracements to get in, which is something that I would be looking at. But are you going in at the worst possible price? Well, the ideal price is at the very, very low. But at the very, very low, you just don't know what is actually going on with the trend. So you've got to have some sort of benchmark place to get in. And this is a very similar process to what I would use if I'm just trading off a 2-minute chart. And once I've got a bit of additional candle confirmation, as in a Hallmey that breaks, maybe with an engulfing, that just gives me that extra little comfort factor that just maybe the trend is moving on in my direction. Yeah, now, Bill, what about the entry the first week in June? Well, in June, I think I sort of mentioned a little bit earlier, where just go back before the end of, well, this is more or less the end of May, where we've got that green candle that moved up from the red, partly obscured by the arrow, popped down to 138, and then the candle immediately after that is the buy candle. Just as it's starting. We're not just going to stick around for it to close, but we're going to get in as close to 140 as possible. Okay? So that becomes an entry, but getting in there, waiting until June, it's too late. It's just too late. It's just too late. So you just stick around and wait, and you get in early. That's the important thing. Now, you may well be saying that, yeah, there's another entry here. And yes, there is. Absolutely right. But then it just turns over and comes on back fairly quickly. Now, the trader, oh, you meant the next swing. Yeah, fair enough. Absolutely. Yeah. Now, let's just go back to this area. Now, it's entirely possible that the trader is going to get in, but then you just stick around, you stay with it, and if indeed price then comes back towards this 55, you're going to be wrong. Now, you don't want to be getting in that late, and the important thing is that you need to get in on these early, so that by the time price is moving on up here, you're in that comfortable position, you've got a buffer of profit, and if you do add in, the add-in contracts are going to be smaller, and if they start to go against you, you get out of them straight away. You do not stick around with something that you bought at 140 to get all the way down to sort of 136 and lower before you actually get out. That's sort of waiting too long. But no, you're quite right. As the next swings develop, then there are umpteen opportunities here with further higher lows to actually get in. No, Borky, I do trade that off the 2-minute chart pretty well every day, but this is not that sort of trading. This is not intraday trading, and all this is to come up with a dead simple strategy to catch the longer term trends. Okay, that's really all this is. And when I swing trade, I swing trade in a different account. I don't want to get my thinking muddled up with the short-term intraday trading. I want to separate the thinking on my longer-term trading. Yeah, well, if you missed the initial move, let's have a look at this one. Over here, okay, price then originally went all the way up to 150. We get the moving averages crossover, but by getting in, if you've got in here once the moving averages have all crossed over, then you're going to be so late, and the possibility of a snapback, as we see, is just too great. So what we're doing, we're looking for the pullback. Now we do get the pullback, okay, we get this rally back, price comes up to 145, it then keels over in the direction of this new trend. Very conveniently, there's a nice little narrow range candle where one can short immediately. That little narrow range Hallmey candle is broken on the downside, go short with a stop, okay, with a stop just above the rally back high. As price moves on down, the only time that I want to get back in, okay, the only time that I want to get back in is where there is a very clear rally followed by an equally clear resumption of the trend, and that trend resumes. Now, the longer you wait to get in for confirmation, the more high risk the trade is. So, I want to get in early, so if I'm wrong, I can get out quickly. All right. There's another opportunity here. As it rallies back, it rallies back. As you can see here, we've got 1, 2, 3, 4 around about the end of February, beginning of March, 4 long tail candles, which are saying that this little phase of the swing, this first swing, is actually coming to an end. Price then moves on up, just manages a crossover, but only just, and comes straight back in again. We've got that little candle there, little mini shooting star, but it then resumed the downtrend. As that resumes on that candle, that's the time to go short, okay? And then, of course, as, if we manage to get in at the right place, which ideally is going to be up there at 145, then I want to stay with it and just capture the profits as we go on down through and protect the remaining part of the position. And just down on down, you see this little horizontal line, would have been the last one. I haven't marked up all of the areas, but I'm effectively trailing the stop. And all I got to do is to look at this on an end of day basis, pop the stop in before I go to bed at night, and that's it. Then what am I looking for? I'm looking for the trend to come to an end, and it comes to an end eventually with a very neat little multi-point 1, 2, 3 type pattern, and it comes to an end in the end of July. Stop would have been taken out, and we're now looking for a long position. And there we go. Right, now in terms of time frame, this is just all off the daily. I'll also sort of reference the weekly and so on, but where I'm trading off the daily, that's where I'm going to be taking my decisions. And we're going to look at the shorter term in just a second. You can enhance some of this. But do I use Elliott wave? Absolutely right. Now, I'm not actually counting these in, but you can count these waves very, very clearly. You see this down wave? We've got a series of waves. We've got 1, 2, 3, 4, 5 waves on down. So where there's been at the end of the 5th wave, then and if I see a multi-point reversal, I'm going to take it seriously. So there we go. Yeah, absolutely. It's between the moving averages. Now, if we've got a runaway trend, it'll just be between the 8 and the 21. And where the trend is not quite so runaway, as we've got here, then it'll go up to maybe as deeply as the 55. What I don't want to see is a close above the 55. Get a close above the 55, I'm out, I'm going to be looking elsewhere. Okay. No, I don't really bother about the 200. Right, okay, well, this is this chart now. We're just following this one along here. And there we are, June, July. June, July. Then the downtrend line is broken. It sets up a higher low. We've got a very early entry opportunity here on the long side after that fifth wave decline and so on. And, just the mere fact you can look at a chart and think, well, goodness me, this thing has moved down in a month, from 132 to 120, okay? Now, that is a lot of pips. It's a lot of pips, guys. And the possibility of a bounce back, just imagine the elastic band is being stretched. It's going to snap back. At some point, it's going to snap back. And where that possibility is strongest is just down here, where you get a higher low. You've probably got a bit of a trend line break, Hallmey break. Well, get in there. Get in there for an early trade. But there we are. Let's look at the next entry opportunity, and it comes here where price, we've got now the moving averages, then the shorter term moving average has now gone through the 55, and we get yet another one of these engulfing candles, okay? Another entry opportunity there. We get yet another one once all the moving averages are crossed over, and it crossed over, and we've got a pullback. Okay, got a pullback, and then on up it goes. These little horizontal lines are where the stops go in, okay, and part of the position comes off as that stop gets broken. And of course the trader then can decide what he or she is going to do with, say, the remaining 100,000 or the remaining lot or couple of lots or whatever it is that they've actually got. Right, where we've got a trend which has been moving on down then, and the possibility it's going to move on back up, then it's anticipating very, very slightly, and the late entry is a perfectly valid entry there at 128. Still got plenty of profit in it. The important thing is to make sure that you only enter when there is a reasonable degree of certainty that price is going to be moving on up. Now, you're never ever going to get total certainty. It's never ever going to happen, because any pattern can fail. Any moving average crossover system, any Elliott wave, any harmonic pattern, they all fail. All we're doing is just trying to put as many odds in our favor as possible. Right, now just over here, we've actually got a new short that's triggered as the moving average is crossed over. But you can see that it fails. Now, I haven't actually put this in, but combine this with Fibonacci retracements, and this actually turned the corner at 50%. And when it turned the corner, it set up a beautiful little multi-point reversal, and that multi-point reversal then triggered, and as we can see, we've got all the crossovers there on that particular candle that shot up there to 130. We then got a minor pullback. This is a runaway trend, okay? Price doesn't even come back to between the moving averages, but it bounces off. It bounces off the moving average. Hallmey break. Just go long. Just go with the momentum. Go with the flow, and you'll make money more times than you'll actually lose it. Oh, Jez, that's a real difficult one, because, I've got a number of things. I want to see a previous trend reverse, okay? And I see it. So I've got, number one, I've got a trend line break, okay? Number two, I've got the fact that price has moved down a very long way in a very, very short period of time, right? Number three, I've then got a multi-point reversal. Number four, I've got the moving average crossover. Well, I've got four things there. And, that's absolutely fine. But there are times when I'll see probably only, say, three of those things, and I'll actually get in, and I'll take the trade. For me, all of these things are relatively fluid. Now, let's just pop down in the time frames. Just pop down in the time frames. In fact, let's just pop back a chart for a moment, just so that we can see what we're looking at here. 140 up at the top, we've got this very early entry, which would have been down there potentially at 122, and then we've got this little correction area at 126. So let's just look at that. We've got 140 right up there at the top, and then we've got the intra-day. What I recommend is that you look at something like the 120-minute chart. Now, it's not hard and fast the 120 minute. I just find it's very, very useful. I mean, that's 2 hours. You might be able to find a similar sort of thing on the 60 minute, but the 120 I find is really quite useful. So what we've got on the longer term chart is an established uptrend. Things are moving on, and if I want to fine tune my entries, I'm going to be looking at these little consolidation areas where there has been a pullback. Okay? There's been a pullback correction and price has moved on up. Now just down here, okay, on the 21st, there's a beautiful momentum candle that engulfs the preceding 3 candles. Okay? Now that's relatively early in the day. It's around about the sort of the European time of day when things really do get moving. And there's a momentum candle. How do I know it's a momentum candle? Well, it just happens to be considerably larger than, well, in this case, the last sort of half dozen or so candles. Immediately after that, I've got another opportunity. Late in the day, it takes off again and engulfs. But I want to get in early during that European session. So I'll stay with it. I'll let this then roll up over a number of days. It then does a little bit of a rollover. How do I know that that's a sensible place to take partial profits? Quite simply because price is overstretched. How do I know it's overstretched? Well, I just look at the distance that price has got from the moving average. If I look at it from the 21 and the 55, it's telling me that it is stretched. Okay, it's getting overbought. I can just eyeball it. I could put a slow stochastic on there. It'll tell me the same thing. I could put an RSI on. It'll tell me the same thing. But always want to be very, very wary of using indicators, those oscillator type indicators, in a trend, because they will very, very often indicate that it's overbought absolutely all the way on up. And it can give some very, very poor signals. So anyway, what do we get here? We get a little bit of a pullback. You see where the moving averages come together. We've got the right candles, so we're adding in a little bit of evidence there. We've got a hammer candle, followed by an engulfing candle. Get in as it engulfs. So we get in there. We get another opportunity where price corrects again, 2 between the moving averages, price moves on up, and there we go. So there we are, dead simple strategy there. If you do want to use the intraday strategy as well, then certainly do. It means of getting in at the optimum time, and it's going to give you some other trading opportunities, some additional trading opportunities. So where one might want to just use three lots to trade purely off the daily, let's have another 3 lots and let's do some intraday trading here, where you just need to take a little snapshot of it a couple of times in the day. Right, so there we are, guys. That's just sort of fine-tuning it off the 1, 2, 3, and this is just then highlighting the areas where we want to get in and the areas where we want to be taking partial profits. Guys, I'm going to have to call it a day there, and I hope that you will be able to put some of this into practice by picking up some of these swing trades just by using those moving averages. Do test it out. Do back test it. You will find that some pairs may be slightly better with slightly different numbered moving averages. But the key thing is you've got to find something which is going to trend and not just drop into a sideways move. Next time we meet, guys, I'm going to be looking at trading sideways moves, because we do see so many of those, and those sideways moves, if they are wide enough, if there are enough pips to be played with, then you can really do rather well out of some of these ranges. Right, guys, there we go. That's the we're not having a great deal of luck with the system this morning. It is www.clickevents.co.uk. Guys, been good to be with you. Apologies about the couple of little glitches this morning, and I'll be with you same time next month.